You should wisely invest. But how? You might follow the very principles and philosophy of Peter Lynch. The strategies of this true legend in the world of investments can earn you financial success this year. Here's how. Even the most novice investor should recognize the name Peter Lynch. You ask why? Because he has a storied 13-year track record of overseeing and dramatically increasing the assets of Magellan Fund, which is why he is such a renowned fund manager. Peter Lynch is the most well-known sage of the present-day financial world. You won't believe that during 1977 to 1990, he increased a $14 million fund to an astounding $18 billion. This really made him highly respected and followed by investors all around the globe alongside Warren Buffett. Lynch formed his investment philosophy while working at Fidelity Management and Research, where he also managed Fidelity's Magellan Fund, which helped him achieve substantial prominence. During Lynch's tenure, which started in 1977 with the fund's establishment and lasted in 1990 with his retirement, the fund consistently ranked among the top stock funds. So as we know, our main issue running into 2023 is high inflation and a rising interest rate, which are causing asset prices like stocks and real estate to suffer. It looks like they are going to be a big issue throughout 2023 as well. So with that in mind, let's first hear Peter Lynch's opinion about investing during times when inflation is up and the interest rate is rising. And what he says might just surprise you in how perfectly relevant it is in the environment. People understand there is 100% correlation between what happens to companies' earnings over several years and what happens to the stock if the company McDonald's has done very well as a company, right? The stock has done very well and people worry about too much money supply. What happens to the price of oil? Who is the president? Who is being nominated to the Supreme Court? It has nothing to do with McDonald's earnings going up over the past 10 years. The stock will go up, but what they will say to you, Peter, is that, as you know, and why I am telling you this, but anyway, it is fun to tell you this, they are telling you these things influence the number of earnings of the particular company because in a recession, people are not going to spend as much money on going to the movies or whatever they do. Therefore, you got to pay attention to these other things because they have an impact on the earth and they are very important. But you have no idea what they are. Alan Greenspan is the head of the Federal Reserve. He cannot predict the interest rate or the long-term insurance rate for 1 year from now, 2 years from now, 3 years from now. He is even surprised. How am I supposed to predict interest rates? How can I predict the economy? You certainly remember the recession of 1982 when there was a 20% prime rate, 14% unemployment, and 12% inflation. I don't remember anyone telling me in 1980 or 1981 that that was going to happen. All of a sudden, we had the worst recession since the Depression, which I did not read about in the papers, so it's crazy to think about these things. Don't focus on macro. You know his point is that, yes, the macro is important and yes, it influences the price. But as an investor, it is one of those things that is short-term and you can control it. So if you can't predict it and you can't control it, then why should you spend your time thinking about it? This is the trap that many investors have fallen into this year. And honestly, it is fair because it is all that the media has been talking about. You know that the Fed has another meeting and they have raised rates, and the Bureau of Labor Statistics were released this month. But you can't get caught up in that sort of stuff as an investor. You need to be laser focused on each potential investment you are looking to make and judge each opportunity on its own. Stocks are not lottery tickets. There is a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away and, first of all, they try and predict the stock market. This is a total waste of time. No one can predict the stock market. They try to predict interest rates. If any interest rate is right 3 times in a row, they would be a billionaire. It is certainly not that many billionaires on the planet. They can't be that many people that can't pick the interest rate because there would be lots of billionaires and no one can predict the economy. Lynch once carried out research to ascertain whether the use of market timing was a successful tactic. The study's findings indicated that an investor would have made a compounded return of 10.6% over a 30 period if they invested $1,000 annually on the year's highest day from 1965 to 1995. A second investor would get an 11.7% compounded return over the course of 30 years if they both invested $1,000 annually for the same duration on the lowest day of the year. Invest for long-term. Long-term investments yield larger returns, which is one of Lynch's many wise words. In the absence of many surprises, he once asserted that stocks are quite predictable over 10 to 20 years. In order to determine whether they will be higher or lower in 2 or 3 years, you might as well flip a coin. As Peter Lynch says, what we need to be focused on is the earnings of each company. When the market falls, however, things begin to shift in the long-term value investors' favor. And that's really what you need to remember. When the market falls, we need to focus on the long term. I may have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 to 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you are 8-fold every 40 years, that's the kind of numbers you are interested in. Then a 10-year bond today is a little over 2%. So I think the stock market is the best place to be for the next 10, 20, and 30 years. The next 2 years? No. I have never known what the next 2 years are going to bring. That's a very good point, and you know the interesting fact that nobody knows. I could get that point across to more people. You know that in the next 2 years, it could go up or it could go down. And there is no way to know which direction. But over 10 or 20 years, the likely outcome bears much clearer. We can take a coin and flip it. I have no idea what the next 1,000 points are going to do. The next 6,000 points are going to be up. The next 14,000 points can be up. The next 20,000 points can be up. But you do not know whether the next 1,000 is going to be up or not. Nobody does, and it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now, and that's what you can rely on. Microsoft didn't exist 20 years ago. Federal Express didn't exist 20 years ago. And new companies have come along that have made this country work. So that's the game. Stay focused on the long term. Peter Lynch's success and stock-picking skills speak for themselves, notwithstanding the possibilities that he over-diversified his fund. He mastered the art of observing his surroundings and comprehending the world both as it is and as it might develop in the future. By putting his teachings and our own observations into practice, you can invest wisely this year and make a hell lot of money. Consider mutual funds. When it comes to investments, mutual funds are a fantastic solution. Equity mutual funds, according to Lynch, are the ideal option for investors who want to buy equities but don't have the time to conduct their own research. Perhaps if you're one of those investors who doesn't have the time or desire to independently investigate a company before making a stock investment, keep in mind that one of Lynch's signature success factors was the Magellan Mutual Fund. With that, we have come to the end of the video. Don't forget to hit the subscribe button and turn on the post notification.